As tensions between the United States and Iran continue to escalate into what could potentially develop into a full-blown war, it's important to know that my portfolio and my new buys start to shift towards things that are more resilient to war tensions. So in this video, I'm going to show you guys the top 4 stocks that I am buying that are going to hedge my portfolio against a larger market downturn if war is to break out. First up, in any situation, we have to understand, is there actually a chance that this is going to happen? And are we going to start pivoting our buys towards a wartime situation and then potentially nothing ends up happening? Okay, this is very important to continue to monitor every single day to make sure that we are making the correct moves. Now, on top of that, I also still want to buy in the normal positions that I'm usually putting my money towards, which are growth style investing, tech focused companies that are strong over the long periods of time. Now, I also want companies in this case that are actually recession proof or cash heavy in that case and are not reliant on wartime growth. See, escalations can be canceled over a single deal or meeting that happens at any period of time. So putting all of my money towards a single wartime stock or wartime profiteers might not be the way that people would want to look at this, because it could end at a single time and then those stocks will go back to the prices that they were at before tensions started to rise. Starting with number 1, we have Nubank, ticker symbol NU. Now, if you don't want any conflicts with US or Iran to affect your stocks, simply get out of the market in general. This is a Latin American bank that helps with saving, investing, protecting, and borrowing across essentially 120 million users and 5.5 million businesses with every single product that you could ever want. Now, even though they have 120 million users, they've grown that essentially 20 million year over year. It's absolutely incredible growth, even though they're one of the largest banks in the entire world. And whenever you compare them to their competitors in their own geographies, their average rating is nearly double of all their other competitors just because their products are differentiated that much. And that's why over 43 million of their users choose Nubank for almost all of their products or their primary banking relationship. Now, you can see that over time, users that originally sign up for Nubank continue to use them more and more and more. And so their average revenue per user continues to climb. So as time goes on, excluding the fact that they're not only growing 20 million users year over year, but the average revenue that they're going to make per user continues to climb, while their average cost to serve those users has fallen dramatically. And the speed in which they're increasing average revenue per user, the number of products per user over time, and their activity rates continue to get faster and faster as they understand what gets them to sign up for 4 products or more, or continue to use primary banking relationships. So they're learning with all of this data of having so many users over time. Now, this is really interesting, is looking at the company's foreign exchange neutral growth rates. If you look at revenue, for example, year over year, they've grown roughly 40%. And in their past history, they've grown anywhere between 61% to 40% year over year. These are insane growth rates for any SaaS business of any kind. But whenever we start looking at how this company is growing on a GAAP basis, okay, we're looking at only 10% year over year. Now, why is that? Well, because the US dollar, whenever it's strong, actually ends up showing that Nubank's income is actually worse because they're using Brazilian reals or Mexican pesos, which if you compare it to US dollars, might have actually been negatively affected over the periods that have already been shown. But as you can see here, the actual US dollar has weakened over this past period. And so Q2 is looking a lot better than what we've seen in Q1, which might actually put a 10 to 20% tailwind on their overall growth rates. So although this has hurt Nubank in the past, it might actually go to benefit them in the future. And so even whenever we're looking at GAAP net income, for example, it still looks like it's skyrocketing and margins are getting better, but there is some start of showing a flattening at the top, which is what investors don't want to see. But in reality, we're still growing 40% year over year. And if the US dollar starts to weaken, this could actually prove to be a massive tailwind into the future. Now, if we continue to focus on their KPIs that they're focusing on, so looking at user growth, average revenue per user, all of those statistics, their efficiency ratio is also very exciting, meaning that how efficient can their actual company be? We are now at the lowest the company has ever seen and one of the lowest in the entire world at roughly 26.7%. That is unheard of. And they'll continue to want to expand in Latin America, potentially expanding into Peru, Chile, Argentina, expand outside of financial services. Like they already have a telecommunications product called NewCell, where they'll offer you, your own phone line and everything for discounted rates if you're using Nubank as a primary banking relationship, and could potentially even expand outside of Latin America. And the person leading the charge here is one of the best aspects of the company. David Velez is one of the greatest CEOs of our generation. Whenever the company had started to face problems during 2021, 2022, David Velez completely cut off his compensation package, estimated to be $423 million, which he just completely gave away to strengthen the company. Now, that made a very, very small impact on the actual business, but overall, it shows a big impact to his dedication to make this company one of the largest businesses in the entire world. Now, if you look at the valuation of a company that's growing at 40% foreign exchange neutral basis and a CEO that is so dedicated to make this the largest company in the world, it trades at a forward price to earnings ratio of only 20 times. Historically, one of the cheapest rates that this company has ever traded at. And I'm telling you this from a perspective of me purchasing this company at $3.80, let alone the first time that I ever talked about it being in the $4 ranges. Being all the way up in these $12 ranges is still one of the cheapest prices that you could purchase if you're looking at it from a multiples perspective, which as an investor, I definitely am. Now, for my next stock, this is a bonus stock, okay? Ticker symbol NFLX, Netflix. Is it discretionary spending, or in hard times, is it the last line of entertainment? Regardless of the economic periods, whether you're looking through 2020, 2021, or 2022, where we've had a mixed shift of macros, Netflix has continued to grow over time, while increasing the total cost of those subscriptions. So if during a more tentative, war type period, will they continue to pull out higher and higher growth? And one of the reasons might be new types of products, which is their ads revenue. Okay. They can show off now a Netflix basic subscription, which lowers the cost to open up to a more lower income or people who are more paycheck to paycheck, while also offering advertisements. Now, the funny thing is are they making less money on these products? No, actually. They're actually seeing some quarters showing off that they're making more money from an ad tier than just offering their basic, 1550 subscriptions per month, which now, as of April 1st, they're rolling out their own in-house subscription model, which is only going to improve margins over time. So that should even be more exciting. And this should bring on more users as they bring on new products like live Netflix, sporting events, and even expanding out to new creators like YouTubers to bring on their own shows, which just diversifies the product lines, wants people to go more towards Netflix and less towards other subscription services, which overall is just going to lead to higher and higher margins as they continue to become one of the largest companies in the world. And from a free cash flow perspective, Netflix is doing all the right things as well. We could start to see significant buybacks, dividends from this business as they continue to have an annual recurring business that is of the strongest quality, which is essentially US recession or wartime, completely resistant. So although the company's stock has continued to rise, we have to monitor their overall price, price to sales and different metrics that you want to take a look at. This could be one company that just continues to increase over time as it is one of the most resistant businesses in the entire world. Now, for my second actual pick, we have a mix here, CrowdStrike Holdings and SentinelOne. And I'll let you pick which one you decide on investing in because although they solve very similar problems, they're very different types of investment styles. Now, security is not a discretionary item. Even in tough macro environments, organizations need to be protected, said the CEO of CrowdStrike. And during wartime, that could not be more important. We're already seeing reports that we could see cyber attacks from, pro-Iranian hacktivist groups against US networks. So this could be a very important thing to start to look at that could benefit from a wartime situation while also being something that is absolutely necessary regardless of if there is some type of conflict worldwide or not. Now, we're going to be looking at a couple slides from both of these companies, but the idea is really the same. What people want is to make sure that they are secured and that if there is companies that could consolidate to a single platform rather than having a multitude of different options, then that could reduce total cost of ownership and complexity for the customers. So these new modern cybersecurity platforms are winning greatly. Now, you can see from this slide here that CrowdStrike has that full end-to-end offering, okay? All designed to lower total cost of ownership and make them win out over their competitors. And obviously, they're much larger than SentinelOne, being one of the highest rated vendors across many of the different product lines that they offer. And customers continue to use more and more of their products over time. So we're seeing, before they used to cover, oh, how many of their customers used to use 4, 5, and 6 of their modules. Now we're seeing them show, hey, how many of them are using 6, 7, and 8 of their modules. And those percentages continue to climb even quarter over quarter. We're seeing the exact same thing from SentinelOne, but I'll show you why I potentially think that SentinelOne could be a better opportunity than CrowdStrike, or vice versa, depending on the type of investor that you're looking at. Now, the total addressable market is clear. Cybersecurity is needing to be modernized. AI native solutions are becoming the golden standard, and the opportunity is massive for both of these businesses. And so for SentinelOne here, although there was insane growth back in 2021, that's very clear for CrowdStrike as well. They are still holding up 20+% growth rates on annual recurring revenue. Remember, this is the cleanest lines of revenue that you could possibly imagine and is not cyclical at all. The annual recurring revenue is the golden standard. And this is across the board, even for CrowdStrike. Although there is declining rates, we're going from an absurd level of growth to even very serious 20+% growth rates that are still very important and could also continue to grow in wartime as well. However, there's a very serious pattern that's emerging. Although CrowdStrike is the bigger player, winning a lot of business, having better margins, and a more mature business overall, you are paying for it. And you're seeing in the price to sales, whether you're looking at the last 12 months or the next 12 months for CrowdStrike's business versus SentinelOne, the difference in their overall valuations is becoming very apparent. If you're looking at enterprise value to gross profit, the difference between CrowdStrike and SentinelOne is the difference of 37 times to 7.7 times now. Price to earnings being the difference of 124 times next 12 months versus SentinelOne being 73 times. You even see it from SentinelOne that they might have a much larger upside. However, these same sort of statistics look back 3 months or 6 months ago showed that SentinelOne also had a much larger upside, but it was closer to $26, where CrowdStrike, although being much lower, showed closer to 440. So although, CrowdStrike's forecast looks lower, they have continuously increased it as they've beaten expectations. See, whenever you look at CrowdStrike versus SentinelOne, SentinelOne has not always beaten expectations, where CrowdStrike is a clear dominator of expectations and continues to prove why people are adjusting their expectations on this business. Either you're the type of investor that wants the number one company that dominates the industry and is willing to pay a premium for that success, or you like to buy the second best player that is essentially being completely overlooked and is severely undervalued due to that type of potential underperformance in different areas, and they always are second best, getting that silver medal. But coming in at number three is NVIDIA, ticker symbol NVDA. Now, whenever it comes to recession and whether companies are going to continue to buy chips, or if there's a war, if companies are going to continue to buy chips, I don't think that anyone says it better than Jensen Huang.
If there's a recession, I think that the companies that are working on AI is going to shift even more investment towards AI because it's the fastest growing. And so we will every CEO will know to shift towards what is growing.
Artificial intelligence will not be slowed down by a slowing of an economy or even war times. In fact, it could potentially accelerate it. In wartime, you're going to want to have the best products available. And if this continues to prove out to be a longer standing escalation between, two major countries, then this could be that, United States is going to pour even more money into try to accelerate their, products that help with data and analyzing the battlefield and all of these different situations that, potentially Palantir investors might be very interested in. But the underlying infrastructure of that is chips and artificial intelligence. And if you take it one step lower, NVIDIA owns that market. So let's talk about that. Whenever it comes to large data centers and the creation of what are essentially tokens, like the lifeblood of artificial intelligence, they're the number one producer. This GB200 NVL72 is the golden standard for computing on how to create artificial intelligence, okay? Essentially, whenever you think about how artificial intelligence works, you think about a brain. Well, this is the brain. This is how the thoughts and how all the reasoning models and everything is created. And the number one company that sells this hardware with all of this software on top, the CUDA-X libraries on top of it, is NVIDIA. And that's what creates their moat. And on top of this, it's not just artificial intelligence in the way that we think of generative AI. There's also autonomous vehicles where we're starting to see rollouts there. Billions of humanoid robotics or specialized robotics in warehouses and factories, right? The need for overall token generation and artificial intelligence is now the next computing platform. This is the largest revolution that I've ever seen in my lifetime, potentially even bigger than the internet itself. And of course, it's leading to massive sales. Last quarter, it led to essentially $40 billion in sales in a single quarter, essentially doubling year over year for the most part. If this continues to keep up, they're going to dominate their overall sales rates, being 105% 5-year compounded annual growth rates. Nearly 75% of all top 500 supercomputers are using NVIDIA. The largest companies in the world are saying that they are going to need to spend more, essentially a 37% increase. And this is not including, the major increases that Meta is starting to increase, now having talks that they want to spend nearly 80 billion plus on things like data center infrastructure. So this number could even be higher, but all of this is going towards buying more chips from NVIDIA or other producers that are creating more and more tokens for artificial intelligence. They think that this is going to continue. Jensen Huang came on stage and said that he sees $1 trillion a year of buying for GPUs and different chips for computing at large. This is data center production at its finest. The reason it's going to increase is that every single business, Google, AWS, Azure, have all said that capacity is at complete constraints, okay? That they are asking for chips at the fastest that NVIDIA will be able to build them. And that's exactly what's happening. NVIDIA cannot build chips fast enough to sell it to all the customers that are asking them to. And so even though we have a company here that's doing $44 billion in revenue, we're still seeing roughly 70% growth rates year over year. This is the largest company to have ever grown at these rates, and we've never seen anything like it in the history of the stock market. And also, it's not done at low margins to sort of help those customers just to gain market share. This is at some of the highest margins we've ever seen. A company that free cash flow bringing in $26 billion at nearly a 60% margin. This is absolutely incredible. They spend nearly $1.2 billion in capital expenditures or property or expense on property and equipment. And yet on the other side of that, they're able to print $27 trillion of cash from operations. NVIDIA continues to beat their expectations of what the market is expecting from them on both revenue and EPS. And the price that they end up paying for a multi-year, 5-year price to earnings growth ratio is only at a 1x. Meaning that they're not overvalued for all of this growth at all. I have many more videos on NVIDIA. It's actually by far the largest company that I hold, so I'll keep this one short. And last but not least, we have Google stock, ticker symbol GOOG, and sometimes L. They got multiple tickers. But Google has not performed as well as people would have liked over the last little bit. And it's mainly because Google search is being threatened by artificial intelligence. People think that if the majority of their searches are starting to go to ChatGPT, why would Google be able to survive or not be hurt by this, change in user behavior? However, Google is wanting to bring a lot of their artificial intelligence products like Gemini to Google search in general. So bringing more personalized opportunities, like Google understands their user much better than OpenAI has because they have decades of user data. Whenever you're also looking at their other products that they could put Gemini in, Google is also a hardware player, right? OpenAI, not so much. And even articles are now coming out saying that OpenAI's new product line with Johnny Ives might not actually be happening, as they've been deleting a lot of those different promotional videos in the YouTube video that they had recently made to announce the acquisition of IO. All deleted, all blocked. So who knows if that's even happening. But Google isn't just a search engine. Google Cloud is one of the largest clouds in the entire world, placing third place, growing very quickly, and is also making up for a larger and larger percent of their overall revenue. If cloud can continue to grow to what is likely a $2 trillion market by 2030, this will be a massive 22+% compounded annual growth rate for the entire industry, let alone that Google might actually be one of the faster players in, this overall cloud race. And also, speaking of cybersecurity plays, Google just acquired Wiz for $32 billion. So if this actually does get through regulators and doesn't actually get probed by antitrust and all of these different situations that might already be taken looked at right now, this could be another massive area that we could see a massive premium on Google stock for, as cloud continues to reach a $2 trillion marketplace. So great acquisition from them, but they continue to bring a lot of the value that people also want from their large cash stacks. Massive $15 billion buybacks every quarter, increasing in dividends of another $2.5 billion going back to, shareholder value. So you're actually able to acquire this company at a 3.4% shareholder yield, meaning that whenever you include the dividend and buyback, people are getting a return on their money, even if Google just stands still. And you're seeing it work because their overall outstanding shares continues to fall over just the last couple of years. So the total ownership of the amount of company that you hold continues to rise, which artificially brings up the stock price. And like I said, it's one of the cheapest rates that you can buy Google at right now, showing a forward price to earnings ratio of just 18 times. Google does not want to fall behind. They do not want to be a legacy player. They're throwing $17 billion a quarter into trying to buy property and equipment like chips to try to improve their data centers, to improve their cloud. They want to be a front runner in the next evolution, which is artificial intelligence. And even with that, they continue to improve their overall free cash flow, bringing a 20+% margin on their free cash flow and nearly $75 billion of free cash flow. It's absolutely insane. They're a cash printing machine, and they're betting on the future through autonomous driving, with Waymo continuing to push out to new cities. They're looking at potentially getting into XR, which is a mix of AR and VR through Android. Quantum, if that becomes a very big reality, Google does also want to be a part of that, making massive breakthroughs through Willow. We're not seeing financial deterioration for search. However, it is poised that could happen into the future. But while we wait, we see cloud, quantum, Waymo, hardware, YouTube, all these other products continuing to grow and take more market share over time. So potentially they will do very well into the future, and you're buying it at one of the cheapest prices you could buy Google in its lifetime. But ladies and gentlemen, if you like this sort of video, make sure you like the video. Consider subscribing. Thanks for watching. Bye for now.